Well, friends, it's been a wild ride for the month of May, and as we wrap up this month, it's interesting to see how the markets have performed and one of the top headlines that drove the markets. Now, we saw one of the headlines of easing trade tensions with tariff delays. That 90-day pause gave the S&P 500 a boost. And we also saw strong corporate earnings, especially in tech, with 78% of S&P companies beating expectation. We also saw some cooling inflation data. We also had bond yield volatility and the growing deficit concerns that spiked the bond auction on May 21, and that obviously drove the 10-year much higher. We also saw a consumer confidence rebound and obviously a continuation of trade negotiations. So that was the top headlines driving the markets in May. But as we enter June, we have now Jamie Dimon screaming cracks in the bond market and current escalating geopolitical tensions between Ukraine and Russia. Very interesting. So we're going to go through the latest macroeconomic data as well as the technicals to give us a gist how we can navigate markets entering month of June. So we got a video packed today, tons to dive into. I'm Danny, by the way. Welcome to the channel. And let's get started. So let's talk about something pretty serious, the US government's debt situation. This chart shows that the cost to insure against the US defaulting, called credit default swaps, has spiked to 52 basis points. That's the highest it's been since 2023 debt ceiling crisis, and outside of that, it's the highest in 12 years. Plus, the amount of these swaps has jumped by almost $1 billion this year. So it's a sign that investors are getting really worried about the government's rising deficit. And get this, the US hit its borrowing limit in January, and they have been using what they call extraordinary measures to keep things going. Sounds like a big problem, right? So let's see how this is playing out globally. So this chart is pretty wild. For the first time in 25 years, the UK has passed China to become the second largest holder of US treasuries after Japan. So China has been cutting back on its holdings while the UK has been stepping up. So why does this matter? Well, with the US government's debt risk going up, it's a big deal to see who's willing to hold on to that debt. And it looks like China might be holding on even more through places like Belgium and Luxembourg. So it makes things a little bit tricky. So let's see how investors are reacting to all this uncertainty. So check this out. Last week, a whopping $1.8 billion flowed into TLT, which is an ETF for long-dated US Treasury bonds. That's the biggest weekly inflow ever for this ETF. Even with all the selling pressure out there, people are piling into these bonds. And it's like they're looking for a safe place to park their money while the government's debt situation gets messier. But this isn't just about bonds. There's more going on in the economy that's making people cautious. So let's take a look at what's happening with consumer spending and housing. So this one from BCA Research has some tough news. The first quarter GDP growth got revised down from 1.8% to just 1.2%. That's a big drop. And on top of that, April's existing home sales fell by 6.3%, the biggest decline in 3 years. So Bank of America also says treasuries are in restrictive territory, which means higher mortgage rates are making it higher for people to buy homes. It feels like the economy might be slowing down, and this could be dragging on what consumers are doing. So let's dig a bit deeper into the housing market. And this is a shocker. So right now, there are nearly 500,000 more home sellers than buyers in the US. That's the biggest gap ever recorded. In 2025, there are about 1.94 million sellers, but only 1.45 million buyers. You can see on the chart how this gap has been growing since around 2021. With fewer people buying, probably because of those high mortgage rates we just talked about, the housing market is really feeling the pressure. And that got me thinking, how are consumers feeling about the stock market with all this going on? So this shows how confident US consumers are about the stock market. Specifically, the percentage of people who think stock prices will be higher in 12 months. It spiked to around 50% in May, which is near the top of its historical range. But here's the question. Are people getting too optimistic, like in a new bull market? Or is this just a short-term bounce before things get worse? It's something to keep an eye on, and especially with the economy slowing down. That brings us to the stock market itself. So let's see how it's been doing lately. Now, let's talk about the stock market. This chart says that 2025 is the third year of a bull market, and historically, year 3 is the worst for returns. On average, the S&P 500 only gains 2.1% in the third year, compared to 36.2% in year 1 and 15% in year 2. Plus, the 3 former bull markets actually ended in year 3, so the market might be stuck with low gains and more ups and downs this year. That's something to keep in mind. But what's been happening in the market more recently? Let's check that out. So here's a breakdown how the US S&P 500 did in May. Some big names had great months like Microsoft up 16.47% and Nvidia up 24.06%. Even Google was up 8%, but not everyone did well. Healthcare like Lilly were down 18% and United Health dropped 27%. So there's a mix of winners and losers, which kind of matches that idea of a bumpy third year in a bull market. But here's something interesting about the S&P 500's recent performance that might give us a hint about what's next. I thought this chart was pretty cool. It shows that when the S&P 500 ends a 3-month losing streak by gaining 5% or more in the 4th month, like we saw in May, it's been positive 1 month later every single time. And 10 to 12 months later, it's up 100% of the time. So with Maine's gain, this June might be a good time to buy. So that's a hopeful sign after all this tough economic news. But before we wrap up, let's look at one more signal that could point to where the market is heading. Finally, let's look at the Nasdaq 100. So this chart shows last week, big commercial hedgers triggered a reader double buy signal on both their short-term and long-term models for 100 or Nasdaq 100 futures. These signals don't happen often, but when they do, they've been a good sign for the market going up. So even with all the economic challenges, there might be some opportunities in tech stocks. Pretty exciting, right? So there you have it, friends. We started with some big concerns about the US government debt, saw how that's affecting bonds and housing, and then looked at the stock market where there might be some opportunities despite a tough year. So what do you think about all this? Let me know in the comment section, but as promised, let's also take a look at the technicals and see where we currently are in the markets. So let's begin by taking a look at the technicals here. Here's the Dow Jones Industrial Average, and as we can see, we have a volume area profile here with the POC line suggesting there's a lot of resistance at this area. However, the good news is that we are above these key moving averages, and it looks like we have climbed above the 55 and the 21, so that's pretty good news so far. So we'll see if we get support here at the 55, and then after that we could likely break out here above this POC line. Let's also take a look at the Russell 2000. We are still unfortunately below this trend line we talked about in the previous video, and we believe eventually that this trend line will break out. However, a safe buy would probably be breaking above that 55 EMA. Why? Because this one has acted as resistance previously. So we're watching the Russell 2000 because any push higher will mean a broader participation in the overall markets. Let's move on to the S&P 500. Still, we are below this Fibonacci level. However, the moving averages suggest that we are above that 21 and 8 as well as the 55. So we have gapped above the 8 EMA, so I would not be surprised that we get a retest here of the weekly 21. So this is how the S&P is looking for now, and let's also take a look at the QQQs. The same story here. Basically, the Qs and the SPY look pretty similar, and we suspect that we're going to get a retest here of one of these moving averages, and then we're also allowing the other moving averages to catch up. Now we're looking at the major indices here on a weekly chart just to give a long-term perspective of how the market is faring out. We're seeing a lot of bid here for crude oil. And what we can do here now is just switch over to a daily, and we can see here that the 55 EMA on a daily chart still remains this resistance area. So here is a former resistance that we have not yet broken out. Should we break above the 55, I do believe that crude oil could actually end up breaking above the 233. And possibly then we would look forward to potentially aiming at this $80 level. Speaking of commodities, we're seeing silver here catching a massive bid. Silver is up 4.76%. This is a handle breakout, classic cup and handle, and we wrote about this on X. But look at silver. I mean, we're above these moving averages. We're above this POC line, classic buy signal here. So we're also going to take a look at gold. The gold is also catching a bid, not as high as silver, but this is a likely initiation of a 1, 2, 3, 4, 5 impulse. However, we do have this value area high that we're closely watching, so we'll see if we get a break above this level, and if we do, I do suspect that gold could continue to break to new highs. But we still remain cautious with gold, because we have mentioned this in a previous video that this correction here would likely need a break below this 8 EMA, and it could take us down a little bit further before initiating a new primary 1-2 cycle. So we are very long-term bullish on gold. We just believe that this needs to correct a little bit before resuming higher. So that's how the markets are looking right now. We're obviously going to give you guys more updates tomorrow. And let's also take a look at the US dollar. The dollar is falling pretty hard here, and we had initially thought that the dollar could catch a bid at these levels. Looks like we are now below this POC line here. So we'll see if we break to new lows here. If we're breaking this low here, that could suggest the dollar could be in for something major. However, as I pointed out earlier, we are above this trend here. We'll just have to see if this slight pullback here is just temporary before we perhaps start to move up a little bit higher. And remember that crude oil chart we just saw earlier, we believe that crude oil in that sense would also catch a bid. So that was it for today's video. We thank you so much for watching. If you haven't already, consider subscribing to the channel. I will try to update you guys as much as possible, and I'll see you guys in the next one. Take care for now.